Welcome, curious minds, to another deep dive. Today, we're cutting through the noise, really getting into the essential insights from Epack Durable Ltd. We're looking at their first quarter financial year 2025-26 results. So if you're looking for a shortcut to being, truly well informed about a key player in India's consumer durable space, well, you're in the right place. Now, Epack Durable, for those who might not know them that well, they're a pretty significant force in India's manufacturing scene. They specialize as an original design manufacturer, an ODM. So basically, they design and make goods for other big brands. We've got their latest reports, presentations, the whole stack right here. And our mission, like always, is to pull out the most important nuggets of knowledge and insight for you.
Indeed, and it's a really fascinating snapshot, actually. You see a company navigating some, let's say, challenging market headwinds, but they're doing it by leveraging their internal strengths, their strategic foresight. We'll unpack their financial health, look at how each product segment performed, and yeah, explore those strategic moves for the future.
Okay, so let's get into it. We're diving into the quarter ending June 30th, 2025. Results just out this week, July 19th. Let's kick things off with the big picture then. What were those headline numbers? Consolidated financial performance for Q1 FY26.
Right. So the operating revenue, that came in at INR 6,624 million. Now, what's immediately striking as you look at it is that that's actually a 14.4% decline year on year.
Okay, a decline.
Yeah, but here's the interesting part. Despite that top-line contraction, their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a key profit measure, that actually grew by 5.6% year on year. It reached INR 546 million.
Wait, hang on. Revenue down over 14%, but profitability up more than 5%.
It's just
Well, that's pretty counterintuitive for most businesses, right? What's the immediate takeaway there?
It strongly suggests a strategic and obviously favorable product mix, and management confirmed this explicitly. Their EBITDA margin, it improved significantly, up by 156 basis points year on year, landing at 8.24%.
At 156 basis points, that's a 1.56 percentage point jump. Pretty healthy.
Exactly. And the net profit margin also saw a good increase, up 43 basis points to 3.46%. Mr. Ajay D.D. Singhania, the MD and CEO, he commented on this. He said they delivered a good performance despite, quote, headwinds in the market primarily due to unseasonal rain in Q1 FY26.
Yeah.
And he emphasized those improved margins were down to adding new customers and, quote, a more optimized product mix.
Okay, this optimized product mix sounds like the real secret sauce here. To really understand that, can you break down how each of their main business segments performed? We're talking room air conditioners, RACs, small domestic appliances, SDAs,
Yep.
large domestic appliances, LDAs, and components.
Absolutely. This is where the story really unfolds. So the RAC segment, room air conditioners, this typically brings in around 65% of their total operating revenue. It contracted sharply, down 34% year on year.
Oof, 34%.
Yeah. And this was directly impacted by, well, suboptimal seasonal demand because of that weird weather, the unseasonal rain.
Yeah.
And also there was a surplus of finished goods inventory across the whole industry carried over from the previous quarter. So tough times for ACs.
Okay, so a significant drag from the RAC segment. That paints a challenging picture. But for the company to still improve profitability overall, the growth must have come from somewhere else entirely. What were the real bright spots in their portfolio this quarter?
Right, here's what gets really interesting. The SDA segment, that small domestic appliances, recorded robust growth, 16% year on year.
16%, okay.
Yeah, driven by strong order intake, both established products and newly launched ones. They noted particularly strong preseason demand for air fryers.
Air fryers, interesting.
And the LDA segment, large domestic appliances, also grew impressively, up 29% year on year. And there, they pointed to customer base expansion as a key strategic driver.
Right. And then the component segment. The numbers I saw for that were, well, they were quite remarkable. That 556% jump just leaps off the page. Does that come with better margins too, compared to, say, the RAC business?
You are absolutely right. The component segment reported phenomenal growth, 556% year on year. Just huge.
Incredible.
And this was supported by a really robust order pipeline. We're talking critical items like PCBs, printed circuit boards, copper parts, plastic molding components. This astounding growth, it's not just a number, is it? It fundamentally, I think, redefines Epack's resilience. It really proves they're strategically de-risking their revenue, moving away from just relying on those seasonal appliance sales. They're positioning themselves as a critical year-round supplier across a broader industrial base. That's the power of their diversification.
Ah, okay.
And yes, to your question, These components often can carry healthier margins, so that contributed significantly to the overall profitability improvement we talked about earlier.
It sounds like diversification isn't just a buzzword for them at all. It's core strategy. Future-proofing, really. Beyond these great segment numbers, what else are they doing, broadly speaking, to expand their reach, their capabilities?
Yeah, that's an important point. How are they building for tomorrow? Well, in Q1 FY26 alone, they secured business with 14 new customers,
14. Well,
and supply has already successfully started with 3 of them. And critically, their component segment diversified into the energy meter sector. That takes them beyond just the consumer durables industry. It's a significant move, opening up totally new industrial applications for what they do best, manufacturing.
that is a clever move, finding new uses for that component expertise. What about their manufacturing footprint and these strategic partnerships? It almost sounds like Epack is, playing chess while maybe others are playing checkers, given how many strategic pieces they seem to be moving.
Right.
What's the sort of overarching goal here with such aggressive expansion in these specific alliances?
You're right. It's a very proactive strategy.
Mm-hmm.
Currently, they operate 3 manufacturing facilities, the Ridun, Biwadi, and Sri City. And these are highly backward integrated, meaning they control more of their own supply chain, which helps with efficiency and resilience. Their positive progression roadmap, as they call it, shows ambitious expansion. They're planning to grow from 3 facilities in FY24 to 4 in FY25, and projecting 6 facilities for FY26. And this goes hand in hand with adding more products and serving more customers. And tying into your point about partnerships, they have some major initiatives underway. First, there's a strategic alliance with Hisense, global consumer electronics leader.
Right, big name.
Exactly. To manufacture ACs and appliances in India using Hisense's tech. This is anticipated to deliver, get this, an incremental $1 billion in revenue over 5 years.
$1 billion.
Focusing on India first, but with export potential to SAARC and MEA regions too. They've got a new facility for their subsidiary, EMTPL, in Sri City, targeting production by end of Q3 FY26, though some ODM supply already started back in March 2025. Second, the EPAVO joint venture, a 50-50 partnership with the Ramratna Group. This strengthens their backward integration for AC manufacturing even more. Focusing on BLDC motors, brushless DC motors, and HVAC products. They have a greenfield facility in Biwadi scheduled to start production in Q2 FY26, so quite soon. And finally, partnerships with other major RAC players like Panasonic and Daikin.
Also big names.
Yes, to produce PCBA controllers, the brains of the units and copper components. This lets them properly enter the electronics manufacturing services, or EMS, business for these critical parts. And crucially, they can leverage benefits from the government's Production-Linked Incentive, or PLI, scheme.
That's a very clear roadmap, expanding capabilities significantly. How do these initiatives, especially that PLI scheme you mentioned, tie into their broader growth drivers?
Well, the company emphasizes several key drivers. The PLI scheme for RACs and components is a big one. It's basically designed by the Indian government to boost domestic manufacturing, making local production more competitive against imports. So it creates a real advantage for companies like Epack.
Right, a tailwind.
Exactly. They're also benefiting from, well, still relatively low AC penetration in India, plus rising temperatures, sadly, but also rising disposable income, a growing middle class, all fueling demand for energy-efficient, smart cooling solutions. And they're also participating in the upcoming ECMS scheme, Electronics Manufacturing Cluster scheme from the government, which should further enhance their edge.
Okay, so with all these moving pieces, these plans,
Right.
what's their overall outlook for the rest of FY26?
Management seems confident. They're stating confidence about achieving their full-year target and continuing revenue growth. They're backing that up with the ongoing capacity expansion and that product portfolio diversification we've discussed. They're targeting substantial growth potential, specifically in SDA, LDA, and components, and focusing on strategies like new customer, new product, and existing customer, new product to really drive comprehensive business expansion.
Right. And crucially for investors, you mentioned their IPO earlier, January 2024. How effectively are those funds being deployed? Is it fueling this ambitious growth? What does it tell us about their financial discipline?
Good question. They completed the IPO back in January 24. A significant chunk of the net proceeds, about INR 20,194 lakhs, that's roughly 2 billion rupees, has already been utilized, primarily for capital expenditure at Biwadi and Sri City facilities, buying equipment, and importantly, a substantial part, INR 8,000 lakhs, was used to fully repay outstanding loans. That definitely strengthens their balance sheet.
Smart move.
Yeah. The remaining unutilized proceeds, about INR 17,651 lakhs as of June 30th this year, are just temporarily parked in fixed deposits with scheduled commercial banks. So it shows a pretty prudent approach to managing that capital.
What an insightful deep dive this has been. We've really seen a company deftly navigating those short-term challenges like the unseasonal weather by strategically leaning into their diversified segments, especially components and small domestic appliances, which really picked up the slack, didn't they?
Indeed, they did. Their robust growth in those areas, plus the significant strategic partnerships and the capital investments. It paints a really vivid picture of a company actively building for long-term resilience, market leadership. That shift towards backward integration, entering new sectors like energy meters. It highlights a very forward-thinking approach. It's clearly about more than just incremental gains.
It really makes you think, doesn't it, about how companies adapt, innovate, especially in dynamic markets when facing unexpected headwinds. So here's something for you to chew on. What really stands out to you about Epack Durable's strategy here? Balancing today's market challenges with that long-term growth vision. And how might their aggressive diversification, particularly into new areas like energy meters, fundamentally reshape their company profile, their competitive advantage in the coming years? Definitely something to ponder. Thanks for joining us on this deep dive.